Hey everybody, Scott with the Market Update Desk, September 27th. We've got more fun going on in the stock market, the bond market, the traders, futures market, lots of stuff happening as we get to the end of the week and some pretty important data drops that happen. Today we had durable goods orders come in for August, showed that we were actually up 0.2%, where the expectation was down slightly. Now, we did also have a 0.5% revision downward to the July report. So there was a negative revision. Um, Still kind of a surprise that we had an increase in durable goods orders. It just wasn't expected. The core shipments within the report showed an increase of 0.7%. So we're showing more products being shipped and ordered. Now, what that is leading to is the theme of higher GDP, gross domestic product. We are likely going to see a revision upward of the estimated Q3 GDP that will come out in a few weeks. It shows the economy is still expanding in spite of the highly restrictive measures that the Fed has been putting in place and credit contraction. So we still have these contradictory aspects going on that the market just is not liking. We need clarity, and it doesn't have it. I wanted to go in why have we been seeing this spike in mortgage rates and associated 10-year bond? There's some specific things at play here that's causing this run up in the market. Number one, we have the biggest short ever in the market history going on within the 10-year treasuries right now. That means people are betting against it, which is not good for mortgage rates. So that's a huge factor. The traders are out there creating a narrative, and it's not helping us in the mortgage world and real estate world. That's one thing. Second thing is oil. Oil has been on this tear for the last 3 months, and West Texas Intermediate crude, WTI, and Brent oil crude are now plus 90 a barrel. There have been forecasts out there that we could be hitting 125 a barrel. That is adding inflationary pressure to everything because energy, oil prices filter through the economy in all different levels. So this is going to continue to create headwinds for inflation and for mortgage rates in the 10-year treasury. This is one of the biggest factors going on right now. The other is we just can't seem to get clear information on the jobs market. We see these positive job growths, and then we see corresponding revisions the next month. When you dig into these reports, the vast majority of these job growths are part-time and secondary employment. So while the numbers are good, the core data deep into it is not positive, and we're just not seeing that out there in the media. The last thing, and this is honestly probably the biggest thing, is the vast amount of government spending creates additional bond sales, whether that's the 2-year bond, 7, 10, 20-year bond. All these bond sales are needed to fund the massive government spending that is going on right now. So this flood of the market of treasuries is hurting us and creating this run up. We'll have to see where this goes, but I don't see an end to that government spending because we haven't even hit the peak part of the Inflation Reduction Act, which is an incredibly large number that's going to be spent. And there's going to have to be additional bond sales to fund those sales. So we have continued challenges. When we look at the percentage of gross domestic product that is allocated for deficit spending, what needs to cover the interest, we're up to 6% of the total gross domestic product. We're forecasted up to 8%. These things are not sustainable. Hopefully those in Washington will start to open their ears and get control of spending. Obviously, in a presidential election year, that's something that is going to be very tough to ask for. Today, we had a great start today the day in mortgage-backed securities and 10-year treasuries. We've now retreated off those levels, and we're down slightly in the mortgage-backed securities by 4 basis points, and the 10-year treasury is flat. We really need to get some momentum going in the 10-year, as if we can bounce off this 4.55 height that we've got in the 10-year, there's a lot of room to run to the downside, which would cause better rates. So the big thing this week is coming out is personal consumption expenditure, PCE, on Friday. If that can come in somewhere better than expected, we can start to get maybe a little bit of a runway to recovering from just this upward trajectory that we've been having. Next week also, we do have jobs numbers. So we do have the potential for breaking through and getting some better opportunities for rates in the 10-year treasury. So we're hoping that happens. We're going to keep you updated here. Give us a call, questions, 616-293-2189. If you could like and share this. We've also created a YouTube page, the Market Update Desk. If you could do me a favor, like that, follow it. We'd greatly appreciate it. Look forward to hearing all your questions. Give us a call to get pre-approved today, 616-293-2189.